Hey guys, hey, I just got an email from a past client of mine, and they were asking about whether or not they should do an equity line of credit. They had done some landscaping and stuff like that, and they were just wondering if they should do an equity line of credit. So I just wanted to read my response to them so you can get some insight into what my thoughts are on it. So I said, hey, hope you guys are doing great. I would always advise having an equity line on the property, even if it's just for liquidity's sake. So I have a $300,000 equity lines on my home just sitting there. If you don't borrow against it, you don't pay any payment. It's just for liquidity. What I'm not saying is go take out a loan and put a bunch of money on it for no reason. I'm just telling you that from a liquidity standpoint, it's good just to have it for my sake, from my standpoint. So here are the upsides of an equity line. You only pay on what you owe, in the sense it's kind of like a big fat credit card with better terms than a credit card. So you only pay on what you owe. So if you don't owe anything, you don't pay anything. It's relatively flexible and it gives you access to liquidity, to capital if you need it in emergency, capital if you need it to invest in something, or if you want to use it for investment property or that kind of thing. And if you go through a kind of a typical bank, generally they're free. So you're not going to want to go through, in most cases, you're not going to want to go through a lender like me, because they're different than first mortgages. In first mortgages, what happens is they're sold on the secondary market, and we can cover some of your cost because we have some revenue to it. With equity lines, the banks hold them on their line, on their portfolio. Then we don't. So what ends up happening is we would have to charge you an appraisal, we would have to charge you title, we'd have to charge you all that stuff, whereas a bank would just do it for free. So here are the downsides that I go through. They are adjustable and interest only, so you definitely do not want to put them out there and just leave them alone. You want a plan to pay them off. Also, right now, as the Fed raises rates, those rates are going to increase. They're adjustable based on the Fed funds rate. So as the Fed funds rate goes up, your rates are going to increase, and therefore your payment's going to increase. So you have to be really careful of that. And when you do go through a bank, as opposed to go through someone like us, they're not as inclined to walk you through stuff and talk you through stuff. So the process can be really arduous and long, and a pain in the butt, more so than working with us. It's just, it doesn't make sense to pay us title and insurance and all that stuff and pay us to do it when the bank will do it for free. So you kind of just want to endure that pain for that gain. So here's what I would say about whether or not you should get an equity line. Number one, yes, it's a good idea to get to an equity line, regardless of whether you use it or not. Access to liquidity is key, especially in uncertain economic times, even if it's just for safety or an emergency fund or something. You don't necessarily want to use it as a piggy bank, for sure. You may not want to use it for repairs if you could pay cash otherwise, and you don't want to pay that interest and you don't have a plan to pay it down. But it's a good idea just to have, just in case. From my standpoint, it's better to go to a bank or a credit union or some you bank with, as opposed to using a lender like myself or any other lenders that specialize in first mortgages, because our specialization in first mortgages, we have an ability to monetize that by being almost like getting a contractor discount going to those rates. So in essence, when you go to a lender like me, you're going to a contractor who can buy the paint for much less than you could pay the paint, and hopefully give you better service than going to the paint seller directly. So we're not going to the same rate. We can earn that through how we do that. With equity lines, there's no mechanism like that really. So we'd have to charge you for a bunch of stuff that you don't have to pay for if you go to the bank, where they're just going to hold on to it and make the interest over time. Yeah. So I would also, the last thing I would say is I would get the biggest line you can possibly get, based on your loan to value and based on your income and everything. Again, you're going to think I'm crazy, because what I'm not saying is run that line up to like 100% of the value of it and take out as much money as you can. Realize I'm saying take out the biggest line that you can, the biggest limit. That means if you take on only a tiny, if you take out a $300,000 equity line and you only borrow 10,000 at a time, you're never going to incur any expense for that 300. But what's going to happen? Number one, you're going to have a large amount of flexibility. Let's say a rental property comes out that's a great rental property. You can pay cash for it, refinance it, pay it back, and that may be a good way to use that as a tool. But more so than that, a lot of times when you do a bigger line, they'll give you a lower interest rate on all of it. So it's a bit of a hack in the sense that if you take it an equity line for $20,000, they can only make so much on $20,000. So they're going to charge you a higher interest rate if your limit is 20,000 because they don't feel like it's even worth paying the cost to do that. So they have to raise their rate to cover their costs. If you take out a $300,000 equity line and you have the ability to borrow that much, but you only borrow 20, you're kind of hacking the system in the sense that they're going to lower your rate because they think that ultimately you have the capacity to borrow up to 300,000 and pay interest on that. But if you just pretend you took the 20,000 out and you never go above that, you pay a lower interest rate on the lower amount. And last thing is, it's an installment in most cases, but there's also less likelihood that your credit's going to have wild swings if you max it out. So if you leave the limit up here and your credit is, and you're only kind of operating in the lower echelon of that and paying it off and using it and paying it off, if you're using it at all, if you manage it the right way, that's not going to swing your credit heavily. But it's the same as credit cards. If you have a credit card with a $20,000 limit and you only put $1,000 on it, your credit's not going to swing. If you have $1,000 limit and you're maxing it out over and over, your credit's going to go wild. So hopefully that gives you some insights into equity lines and what my advice would be as it relates to taking out equity lines. I think they're a good tool, especially right now when it really doesn't make sense to refinance because the rates are so high. They could be a good access to capital point, but you're going to want a way to pay them off in the short term because they're adjustable, they're interest only, and they're tied to the Fed funds rate. So be careful of that. And hope you guys have a good day. Thanks for listening.